Hi, my name is Michael Wander with Wander CPA. I want to talk briefly, 5 minutes, about when a C corporation can reduce your taxes. C corporations generally have a reputation, and they have a bad reputation for having double taxation. They're taxed when they have their income. The corporation has income, it has an income tax, and then it's also taxed when it distributes its income to its shareholders. So generally, they are not the preferred vehicle for tax savings. However, there are certain scenarios where they are beneficial and they do provide tax savings, and I'm going to go through that scenario right here. Take, for example, a physician that has income of $400,000. This example is taken from the book Tax-Free Wealth by Tom Wheelwright. Income of $400,000. Now, taking a look at this chart, this table over here, right? This is showing us for 2021, for married filing jointly, that if somebody has taxable income that is between $329,851, so larger than $329,850, and below $418,850, which our taxpayer falls into that category, then they're going to be paying $67,206 plus 32% of the amount over this amount right here, the $329,850. And basically, it's just this 10% of this $19,000 plus 12% of the difference between $19,901 and $81,050 plus a 22%, etc. So if you were to add all those up, it should give you $67,206, and then you're going to take the 32% of the difference in here. I hope that's fairly clear. I'm not going to run through that specific calculation. It's pretty self-explanatory, and it's available lots of other places. If you have a question, let me know. But so basically, okay, fine. So scenario one is where there is no C corporation. Scenario two is where there is a C corporation. So in scenario one, again, this is the $67,206 that we see over there. And also in scenario two, the same. But in scenario one, where there's no C corporation, the $400,000, right, minus the $329,850 gives us $71,150 right there. So if you multiply that by the 32%, which is what this line right here is telling you, then you're going to get $22,448 in tax just for that incremental amount of income, of taxable income, which takes you to a total of $89,654 in taxes due for this taxpayer, this person, this human being. Now, scenario two is where there is a C corporation, and C corporations have a tax rate of 21%. So you basically you create a C corporation, and you pay the C corporation for services, legitimate services, marketing, let's say, whatever types of services the C corporation can do for you. You're still the sole shareholder, and then you pay the corporation. Let's say in this scenario, you pay the corporation the difference of the $70,150, which is the difference between the $400,000 minus the $329,850, and then that amount, the C corporation, is going to get taxed at the 21% rate. You are not going to pay that because you're only going to have, right, the taxpayer is only going to have $329,850. The corporation is going to have $70,150 in taxable income, so they're going to pay 21%, which is $14,732, and plus the $67,206 for the individual amount of $329,850 for a grand total of $81,938. So you can see right here, they saved a total with this one scenario of $8,000, a total of $8,000 by forming the C corporation. So as long as the administrative costs of running the C corporation are going to be less, including the bookkeeping, etc., filing the corporate tax return, are going to be less than $8,000, and your time, of course, then in this scenario, it will be worth it. Now imagine if this income went up, 500,000, 600,000, right? Where the tax bracket goes up to 35 and 37%, you would have that much more savings. I hope this is clear. Hope this is interesting. Let me know. And again, C corporations are generally have double taxation, but there are scenarios where C corporation would be beneficial. My name is Michael Wander with Wander CPA, and have a wonderful day.